morning all. I am Dr. Manoj Kumar NV, working as an Associate Professor in the Department of Management Sciences, Maharaja Institute of Technology, Mysore. So today we are going to be solve the problem on book value and market value in mergers and acquisition. So the subject name called mergers acquisitions and corporate restructuring. Subject code is 18 MBA 18 MBA FM 401. So today we are solving a problem on market value and book value calculation. So whenever the companies are concentrating to target by the acquirer, where they are going to be evaluate the firm value by considering the book value as a intrinsic value, we can call it as, and market value consideration and net asset value method. So these are all the several methods where they are going to be used to determine the value for the company to target. So today let's see, with respect to solving this problem, we can able to understand that how the value of the companies are differ in under different situations. So as here they given the information regarding to the balance sheet of as on 31st December 2008. Also they given the income statement information. So by using that, they given the additional information pertaining to the free cash flow calculation and market value calculation. Also they given some information regarding to the EVA, economic value added model. So therefore it will be helpful to the organization and evaluators to understand and to identify the value in these methods, which makes that the investment become more profitable. So first we are moving to the net asset value method. So in under the net asset value method, the name only indicates it's a consideration of the assets and liabilities. So where we require to be list out under the net asset value method under book value calculation. So based on the book value basis, we are calculating the net asset value. So therefore whatever you can find the items in the balance sheet, based on that we are going to be prepare the net asset value here. So therefore first we require to be list out all the assets which they provided in the problem in the balance sheet, where we have a land and building, plant and machinery, then stock, then debtors, and also we have a bank balance. So therefore whatever they given the information regarding to all these assets, we require to be take the consideration in the calculation. So therefore as per the book value they given here is where the land and building which does not have any adjustment. So if there is a adjustment, then we need to take it in the inside column. So therefore without adjustment we can take it directly to here. So it's amount rupees in lakhs. So land and building, the worth is 250 and plant and machinery is 300. And the stock is 100 and debtor is 120 and the cash at bank is 30. So therefore, we need to take the total as a total of assets, total assets which amounted to rupees 800 lakhs. Then we need to be less the liabilities which are external. So in the balance sheet you can find that there is two major liabilities which rise from the external investors. So the first one is 12% loan, and the second one is current liabilities. So the loan amounted to rupees 200 and current liability amount to rupees 300. So then we get the total liability is total liability amounted to rupees 300. So hence the value of the firm. So consider this as a and consider this as a B. So value of the firm which equals to A minus B, where 800 minus 300 which we got 500 rupees as the value of firm. So this is the calculation which is required for the consideration under book value basis. So after you calculate the book value, total value of the firm, then you can take the consideration. You can take the consideration of net asset value per share So net asset value per share, where you are going to take the consideration of whatever the value of the firm which are calculated. So NAV per share which equals to the value of the firm under book value divided by the number of outstanding shares. So when we take the consideration of outstanding share, whatever they given in the problem, that is 10 lakh rupees. So therefore 500 lakhs divided by divided by 10 lakhs where we are resulted rupees 590. How come 590? Sorry, this is 890 lakhs. So therefore we are resulted with 590 lakhs. So therefore 590 lakhs divided by 10 lakhs. So we get rupees 59 as a NAV per share. So then we are moving to the second calculation. The second calculation should be based on the EVA. So therefore where we require a P ratio method. So therefore after we calculated the net asset method, we are moving to the P ratio method. So in under the second calculation is P ratio method. We can also call it as it's a market indicator. So where here whatever the given EAT in the problem, so earning after tax they given in the problem, that it is amount to rupees 117 lakhs. So therefore directly we are going to be make use of P ratio to calculate the market ratio method. So where we can able to ascertain the EPS, which is equals to 117 lakhs. So EPS equals to, we can put the formula PAT divided by number of shares. So therefore 117 lakhs divided by the total number of shares are there in the company is 10 lakhs. So therefore we are resulted 11.7 rupees. So therefore as per the EPS which we are resulted, so 11.7 rupees. So then we can able to make use of P ratio formula. So P ratio, price to earning ratio, so MPS divided by EPS. So as per the problem they given the P ratio is 10 times. So therefore we can easily calculate what will be the MPS. So therefore we replace the variables. So MPS equals P price earning ratio into EPS. So price earning ratio 10 times they given in the problem, and when we are multiply that with the EPS which we are resulted rupees 11.7. So therefore it become the market price per share become 117 rupees. Hope you understand where we are follow under the price earning ratio method, where they given the EAT as well as they given the P ratio in the problem. So by using a EAT we can easily determine what will be the EPS. So EPS equals, we are going to use the formula PAT divided by number of shares. So PAT they given in the problem that it is 117 lakhs, and number of shares that also they given in the balance sheet, that is 10 lakh shares. So when we divide it we will result it with EPS earning per share is 11.7. After that we are going to make use of the P ratio formula to determine what will be the MPS. So MPS equals PER into EPS. Then PR they given in the problem it's 10 times, and we are going to multiply with the 11.7 and resulted with 117 rupees as a market price. Then we are moving to the third method, that is free cash flow method. So in the free cash flow method, first whatever the given cash flow in the problem, as the first adjustment they given the cash flow to calculate the free cash flows. So based on that, first we need to be convert the free cash flows into present value of free cash flows. So therefore we require to make use of the table, use the 4 columns including year and whatever the free cash flow they have given, and then you have to be take a consideration of the future cash flows you are going to be converting to present cash flow. So therefore you have to make use of the cost of capital which they given in the problem. So the cost of capital they given is 15%. Then we are going to calculate what will be the present value of future cash flow. So therefore, where we are calculating the present value of future cash flow, where they have given 5 years and the given cash flows are in lakhs, rupees in lakhs. So that is 250, 300, then 380, 400 and 500. So these are all the cash flows, free cash flows they given in the first adjustment, and we are calculating the PV factor at the rate of 15. So that also they only given 15%. So based on that, 1 divided by 1.15. So 1 divided by 1 plus R. So press the equals for 5 years. You will be get the factors value. So 8696, and when we multiply that, we will get 217.40 and 0.7561. So multiply with the 300, we get 226.83. Then for the third year, where we get the fraction is 0.6575, multiply with the 380, we will get 249.85, and the next year 0.5718, then into 400, 228.72, and the last one 0.4972. When you multiply with the 500, you will get 248.60. Then we need to take the total of this. So when we take in the total of that, it become 1171.40. So after you calculated the total of PV of FCF. So once you are calculated the particular total of present value of free cash flows, then we are going to be explicit the forecasted period. So we need to be calculate the terminal value, present value of terminal value. So here we require to be take the consideration of TV5. So TV5, where we are considering FCF of 5th year into 1 plus G all divided by KE minus G. This is the formula which we are using to calculate the terminal value. So the terminal value in the year 5th year here is 500, and we are going to multiply with 1 plus G. So therefore the growth rate they given is 0.05, and the cost of capital which they given in the problem is already we have taken consideration for PV factor, it's 15%, and the growth rate is 0.05. So when we subtract that value, it will be 5,250 lakhs. So after we convert the future terminal value, then this terminal value with the end of 5th year. So therefore that 5th year value we should need to be converting to present value. So present value in the year 0. So therefore present value of TV5, which we are resulted here, where we need to consider TV5 terminal value at the 5th year into PVIF. Here is R year is 15% and N year is 5. So therefore TV5 is rupees 5250 lakhs into PV factor. If you look at the PV factor at the 5th year, already you have taken consideration for the 5th year PVIF. So take the same thing, 0.4972. Then you are going to be resulted with the present value of the future cash flow that amount to rupees 2610.30 lakhs. So after you calculated the present value, then you require to take the total of the present value of terminal cash flow as well as the total present value of FCF. So therefore when we combined the value of the firm, where the present value, the total present value of future free cash flow plus present value of T5. So T5 means it's a terminal value. So therefore the combination become total FCF. Total present value of FCF. So therefore where we are resulted the total value of present future free cash flow is 1171.40 plus the terminal value is 2610.30 lakhs. So totally which we are resulted 3781.70 lakhs. Then we are going to be less the external liability from that. So the external liability which we already taken consideration in the NAV calculation. In the NAV calculation, the external liability which we consider is 300. So when we less that, where we are resulted with the FCF avail to equity shareholders is 3481.70 lakhs. Then if you want to convert these into the market value of the firm, so market price per share become market price per share, which is equals to whatever the FCF value we got, total FCF divided by number of shares. So total FCF is here we got 3481.70 and it should be divided by 10 lakh shares. So where we are resulted 343.17 rupees are the market price per share. Hope you understand well. So whatever they given the 5 years free cash flow we are taken as it is, and there is no growth rate they incorporated here, because already here growth rate included. So therefore directly we taken the consideration of free cash flow. Then considering a 15% cost of capital, we are determining the factors. Then you are going to multiply the free cash flow into factor, you are resulting with the present value of FCF. Then take the total and considering as a total present value of free cash flow. After you determine the free cash flow, then you require to be determine what is the present value of terminal value. So terminal value means whatever the end year in the project. So here the end year is 5th year. So therefore on that 5th year we require to calculate what is the terminal value by considering the futuristic period. So therefore free cash flow of the 5th year into 1 plus G divided by KE minus G. 500 plus the growth rate with the given in the problem is 5% and the cost of capital is 15%. We are resulted 5,250 lakhs. Then after we converted that terminal value means where we are calculated that value for at the end of 5th year. So therefore we require to be convert this into the present value. So therefore whatever the terminal value which we are resulted, we are going to be convert that into the present value interest factor at 15% 5 years. So you can look at A3 table, you will get the 0.4972. Otherwise whatever the calculated value here at the 5th year, same fraction you can take it here and multiply the both, you will get 2,610.30 lakhs. After you can take the consideration of this, once you calculate the present value of free cash flows and present value of terminal value, then you are going to be add both the value to arrive the total FCF. So once you calculate the total FCF by considering the whatever the calculated value of free cash flow and terminal cash flows, then you will get the total FCF. From that you are going to be less the external liability, which is already we are take consideration in the net asset method. That is external liability 300 we already consider. So from that we are going to be less that. Then we are resulted with whatever the profit which is available for equity shareholders is 3,481.70. Then we directly put the formula for MPS, market price per share. Whatever the FCF we are determined, we are going to divide it with number of shares. So number of shares they given in the problem is 10 lakhs. So therefore when we divide 10 lakhs with the FCF, we are resulted with 348.17. Then we are calculating the fourth one, the computation of EVA, economic value added. So where we require to take NOPAT, net operating profit after tax, or you can call it as EBIT. So they given in the problem it is 200, and from that we require to be less the corporate tax. So corporate tax at 35% they given in the problem. So 200 into 35%, we got 70 lakhs. So therefore we are end up with 360. We can consider this as a profit after tax or net operating profit after tax. So from that we are going to be less the cost of capital employed. So cost of capital employed, here there might be a chance of whatever the total capital which is raised by the company, we also determine the cost, they given the cost of capital. So therefore the total capital of the company which is amount to rupees 700 lakhs and the cost of capital they given is 15%. So when we determine that, it is amounted to rupees 105 lakhs. So therefore we are resulted with the 25 lakhs. So that you can consider as economic value added. So therefore you can say that the firm still, after meeting all the long term liabilities and the default risk with respect to tax and all, still the company have a value with respect to 25 lakhs under EVA method. Then we are going to calculate the calculation under computation of market value added. So computation of market value added, so the total market value we have to determine total market value, which is equals to whatever the total number of shares are there. So as we already known, the market price they given is 100 and total number of shares among number is 10 lakh shares. So therefore we are resulted with 1000 lakhs So 1000 lakhs. So from that we are going to be less equity shareholders funds. So equity shareholders fund, out of this we have 500 lakhs. So therefore 500 lakhs, you can see that in the balance sheet where we have a whatever the equity shareholder fund in connection to the shareholders value, reserves and surplus, where we can take a total of it. So that amount to rupees 500. So therefore the market value added will be 500 lakhs. Hope you understand this, where we are calculated the computation of EVA, economic value added, where we take a consideration of NOPAT, net operating profit after tax, which is the given is 200, and from that here in the economic value added, depreciation should not taken into consideration. So therefore directly we are going to be charged the tax on whatever the profit which we arrived. So then we are resulted, after we calculated 35% on 200, we are resulted with the 70, and from 200 if you less 70, you are resulted with the profit after tax, or you can call it as profit after operating profit after tax is 130. Then from that we are going to be less the cost of capital employed. The total amount of capital which we raised is 700 lakhs and the cost of capital they given is 15%. So you need to be charged the cost of capital on total capital employed, and we are resulted 105 lakhs. So once we less 130 minus 105, we are resulted 25 lakhs as a economic value added. If we go with the calculation of market value added, where we need to take a consideration of whatever the value they have given as a market value, and we are going to be multiply with the total number of shares, equity shares which are available in the company. So that is amounted to rupees 1000 lakhs. From that we require to be less the net worth or equity value. So equity value is the combination of the equity capital, reserves and surplus. So totally it is put together 500 lakhs. So from 1000 if you less the 500, you are resulted with 500 market value, 500 lakhs market value. Hope you are understand this problem. So where as an investor, as an advisor, they must need to be known how to determine the market value added, economic value added, whether it is profitable to the company to target So therefore such decision you can able to easily place by calculating the market value added and economic value added. Also the free cash flow and the market capitalization, that is also helpful to you to determine whether the target is beneficial to us in future. So thank you for listening. Hope you are understand well. Thank you one and all.